All right, we're going to go ahead and get this thing started. Hey, you got John Hopkins here. I want to welcome everybody for today's event. This is a Q1 earnings season sneak preview. Got a good crowd in here today, including people new to Earnings Beats. I want to thank you for giving us a try. Of course, a lot of our seasoned veterans as well. Thank you for taking the time to stop in as well. For those of you who are new or those who never attended one of these sessions, this particular session, we do these quarterly. And this is actually just a little warm up for the formal session, which is next Monday, same time. And by then, a good number of important companies will have reported their numbers. We'll start getting a sense, for what the market's thinking. And then there'll be still a ton of other companies getting ready to report. But today, when Tom comes in, it's really sort of giving you a sneak preview of the types of things that he'll be looking for when we have the actual event next Monday. Now that'll be a members only event, but that means even if you're on a trial, you'll be able to attend that session as well. And it should be very interesting by then. I did notice after the bell, IBM reported, and their numbers weren't off bad. They beat earnings per share by a little bit. Revenue's a little bit shy. Stock is down a couple bucks after hours. And you might imagine they gave no forward guidance. So get ready for that theme, right? Here's what we did. I mean, they're going to, I guess one way to look at it is everybody's going to get a pass in terms of forward guidance. So it becomes a little trickier, to try to determine how a stock might behave. But as usual, there's a lot of indicators that Tom looks at that helps him determine if a stock, what the chances are of the stock going higher or lower. One I'm going to be watching very carefully tomorrow night is Netflix, because Netflix has just been a big leader, and a lot of great expectations for the stock. If you look at the chart, it looks like it could come through. If it disappoints, I think the market wouldn't like that, but we're going to find out. I'm sure Tom has an opinion on that. Just want to let you know this session's being recorded. So if for some reason you can't stick around, don't worry, we'll make sure you get a copy of the recording so you can listen to it at your leisure. Questions, I try to answer them, throughout the session if I can. If there's time, Tom will tackle a few, but quite often we just run out of time. But you can always send us questions at the site, right? Go right to the contact us link, and we'll be happy to answer. Anyways, I'm going to go ahead. I'm going to check and see if Tom's ready to roll here. How's it going, Tom?
It is going well. Good afternoon, everybody.
Good. We've had so many webinars lately that I'm glad we reminded you this morning that we had this one.
It was actually kind of funny. I didn't have any idea I was doing this until this morning when you said something. It's like, wait a minute, we got another webinar?
Yeah, I'm telling you.
I feel like I'm doing these like in my sleep now.
You probably are. Anyways, I was just saying IBM reported they're down a couple bucks. Not a big deal. Down. And I noticed today, I know it was this whole oil thing, like the contract for May expiration tomorrow.
Yeah.
You had to pay. Forget about having a price for it. You had to pay for them to come take the oil away, and nobody has any storage. So this is going to be, kind of interesting to keep an eye on. And then, of course, tomorrow we got Netflix. Like I was saying, that's a biggie, I think, because they've been such a force. And we'll see if they come through. Anyways, I'm going to step aside, let you take it away, and have a good one.
Yeah, I have to. I mean, when I looked at that crude oil price,
yep,
I went over to CNBC, and first of all, I mean, I don't even know what to make of that. I saw it and I was like, wait a second, minus 2250.
Yes.
That doesn't sound right. And then I saw it was down 40.
Yep.
It was down 223%. I don't even know how that works.
Yeah.
So if I go get gas, they're gonna pay me to put gas in my car?
I don't think they're going to pay you, but I think gas is going down. You know what I think's amazing is how well the market held up in spite of, oil being down, negative 40, 200%.
I don't understand all these things that are negative now. I mean, interest rates around the globe going negative.
Yeah.
And now crude oil going negative.
That's it.
I'm used to my portfolio going negative. I've seen that before.
Oh, yeah.
But yeah, I mean, I didn't really know what to make of that when I saw that crude oil prices were down like that. That's crazy.
Yeah.
But I do know that there's some volatility, when you go from one contract to the next month, from the first, forward month to the latter month or whatever. So we'll see what happens tomorrow with the newer contract, because I think this one expires tomorrow, right? Isn't it? I think it's Tuesdays. The oil futures contract expires tomorrow.
Yep.
Yeah, but that's just crazy. But anyway, good afternoon, everybody. We are going to get started in just a minute, but I thought what I would do first is just kind of talk a little bit about what this session is all about. So I'll tell you a little bit about what we want to talk about today. So here's just a really rough little agenda that was put together. And the first thing that we'll talk about, I'm kind of making light of, it's an election year. And I don't know if you ever watch these election results. Sometimes I'm pretty fascinated by them because they'll, a state will be in and they'll say, okay, with 2% of the precincts reporting, we're now able to project a winner. And I'm looking at it and thinking, well, 98% haven't reported yet. But I guess they've got their computer models and their statistics and so forth. So I thought what I would do is start out this webinar talking about a couple of the earnings reports that have come in, because literally it's like 2%, maybe 1% of all the companies out there have reported their results. And as John said, we're going to get a lot of, well, we don't know what's going to happen next quarter. I think there's going to be a lot of that type of guidance, especially those companies that just can't, come up with a good estimate with what their business might look like, because they're going through so many changes and they're trying to figure out, okay, well, maybe we need to get our employees hooked up at home with Zoom, which is, by the way, the technology we're using for this webinar today. A lot of companies are going with Zoom or Ring Central or, some of these different platforms to be able to communicate without being face-to-face. And so a company like Zoom, I would imagine, is going to post some very robust results. And, I don't know what they'll do with guidance. They might be a little bit, well, if they're smart, they'll be conservative with it. But, they may give guidance. But you've got other companies, old school companies, that are dealing with this and trying to just figure a way forward. And so it is really hard to give guidance when you don't know whether the economy is going to open back up in May. Is it going to be June? Is it, when are people going to come to work? What's all that going to look like? Are the consumers going to come right back out and spend money? There's a lot of questions. So this will just be a really brief look at a few companies that have reported, and a couple of them I think that look pretty good based on not just their reports, but also based on the way they're trading. And I know many of you, especially Earnings Beats members, or those of you that read my blogs a lot, know I've been talking about accumulation distribution quite a bit. And it all that was one indicator I never used at Stock Charts. I knew what it was, but I just never really felt the need, never really saw the value in using it the way that I looked at charts. But when I saw all of the gap downs in March with recoveries during the day, I didn't want to use RSI. I mean, that to me is just, not really that meaningful. I love the PPO or MACD, if you like the MACD. I mean, I love those indicators, but there's no volume involved in that. And just about everything went down. So all the MACDs and PPOs were below center line. It was hard to distinguish between companies. And then I started looking into the accumulation distribution. And it really is just, it looks at volume and it looks at the current day's action intraday, not what you did versus yesterday, but literally intraday from the high to the low and where you finish, and then taking volume into account. I thought, well, that's the indicator that I want to be taking a look at. So I did a lot of studying back in March during, when this first was starting. And I realized that what was happening is the stock market was gapping down. Just about every stock in the market was gapping down. But then after the opening bell, there was a divergence. And we saw this divergence where the weak stocks, the ones being distributed, just kept getting weaker throughout the day. So they would gap down and keep going down. And then you had this other group of stocks that would gap down because the market was weak at the open. Everybody was panicking, so they're selling everything. But then there were buyers that came in at 9:30, and those stocks were going up during the day. And accumulation distribution is a great tool to use to really visualize what's taking place in the market. So I've been using that tool quite a bit, both in my blogs, in the webinars here with Earnings Beats members, my daily market report that goes out to members. It's really become a big part of what I do. Now, I don't know if 3 months from now it's going to be a big part. We'll continue to monitor and see if it continues to give us valuable information. But for now, I think it's a critical part of looking at the market based on the way the market's been performing. I mean, today was very similar. We had the gap down, then we rallied back. NASDAQ went positive. I mean, we've been seeing this a lot. But we did have selling at the end of the day. And this historically is a bad week for the market. 19th to the 25th of all calendar months have produced annualized returns of minus 8% since 1950. So you start getting around option expiration Friday and the week following, and that tends to be a really difficult period for the market. And we've had a big run up. So this could, I think this is going to be a week that's really going to test the bulls. And so we saw weakness early, we bounced back, but then we saw that weakness coming again at the end of the day. So we might see a little bit more selling this week. I wouldn't be surprised. But talking about the overall market, that'll be for a different day. Let me keep going. So we'll start off talking about some of these earnings reports that have come out, maybe just a handful of companies I think look pretty good. Then we'll take a look ahead at some of the key upcoming reports. And I'm just going to look at the next couple of days because, as John said, next week we're going to have our we're going to have a lot more reports that have, a lot more companies that have reported. Take a look at more and more of these companies that are starting to look really good on their charts based on their earnings. And then talk a little bit more about upcoming, because we have a lot more companies coming up starting next week and the week after. So next week it'll be tonight's webinar on steroids. So if you like what you see here tonight, you definitely want to be back for next week. And as John mentioned, you don't have to be a fully paying member. You can be a trial member. So if you like what you see tonight, sign up for the trial, and then you can come back next Monday and get that bigger version of what we're going to go over tonight. And then I'm going to wrap up with some emerging leaders. And this is going to be looking at the strong accumulation distribution chart list that was put together. I think you'll really be impressed if you haven't seen that yet. Action today was kind of like it was back last Thursday. I wrote about it in my blog. Also talked about it with members over the weekend in our war room on Saturday. Just the performance between the strong AD chart list and the weak AD chart list, AD being accumulation distribution, the performance was just crazy different. And so every time I see this, I become more and more convinced that you want to be looking at accumulation distribution in concert with your relative strength. You want both. Just because I've seen charts where a company is going down, just keeps going down and is, lost 70% of its value from where it was 2 months ago, but it has a strong AD line. I'm not buying that because the stock is still not even keeping up with its peers. If a company is one of the worst companies within its peers, it's hard to argue that it's being heavily accumulated. So not every time you see a signal or a technical indicator that points a certain direction, you have to understand there are limitations for every indicator. So you want to be careful just making blanket assumptions that, oh, the accumulation distribution is pointing up, that means I should buy. That is not what I'm saying at all. When we get into this strong AD chart list, you'll see that these companies are companies that not only have strong accumulation distribution, but also very strong relative strength. And that combination is powerful right now in the market. So that's what we're going to go over tonight. I don't think this will be a long one. You all that have been coming to these webinars know I can talk for hours. This one hopefully will be done in about maybe 30 to 45 minutes from now. I don't think it'll be very long. Famous last words. But I'm going to shoot for 5:15, which would be 45 minutes total. So let's go ahead and get started. I'm going to start out with companies that have already reported. So let me pull up the charts. Okay, first I want to go over RPM International. This was a company that reported back on April 8th. They beat their earnings per share number, but they did not beat revenue. So also those who have been members of Earnings Beats knows that we keep a strong earnings chart list. And you can't get on that chart list unless you've beaten both quarterly revenues and earnings and your liquid, meaning that there's enough shares that trade throughout the day, at least 200,000 to 300,000 a day. So I want liquid stocks. And then also these stocks look good technically. They've got strong relative strength and so forth. So you're not going to see RPM on that chart list because they didn't beat the revenue numbers. They came up short. But I like the reaction to it. And if you take a look at this chart, you'll see that the accumulation distribution continued moving up. See how the stock price was going down, but accumulation distribution's going up? If we go in and we take a look at, say, the QQQ and the spider, I'll come back to RPM in just a second. But for those of you that are new, here's the QQQ going down. Notice that after we had this first drop right here in the accumulation distribution, with the next big drop, we didn't break down. We actually had higher lows and just recently broke out to a new high in the accumulation distribution, even though price is not broken out. So the whole point here, again, is when I started looking at this, I realized that you've got a lot of hollow candles in here, meaning that you closed above the open. So, you know, if you go back and look at the end of February and throughout the first half of March, there were a ton of days where we gapped down at the open. But we rallied back off of those lows quite a bit. Or it looked like we were going to be really, you know, bad, and then we rallied back. Like here's a hollow candle here, it looks like on March 13th. Let me annotate it so you know which one I'm talking about. But right here, see that candle right there? So here we closed down here. We gapped up, had this huge gap up, came back down intraday, put this long tail in, and then came charging back, closed near the high of the day. It's hard to do that without buyers intraday. Somebody was buying. To have that kind of volatility, that kind of movement to the downside early, and then to finish all the way back up near the top. I mean, from the low, which was probably 177 and change, we finished at 192, $15 off the low. That's a lot of buying of NASDAQ 100 stocks to get the QQQ to do that kind of reversal. And when you look through, even at this first bottom, this was the day that really started it because we were going down. The accumulation distribution was going down. And then all of a sudden, we gapped down, we rallied. And then the next day we rallied. And after one red day, we came back, we rallied again, another high. And then as we started moving down, you see there were only about 3 days where we had filled candles, meaning we closed below the open. Every other day on this way to, on the move down, we closed at least where we opened. In many cases, we closed like we did this day on March 13th, closed at the high, well above the open price. So that's what got me thinking about, okay, accumulation distribution, because you can see accumulation distribution held up and then we broke out. If we take a look at the spider, you're going to see basically the same thing. And when you look back at 2008, the big drop we had in 2008, it was nothing like this. The initial move down for the spider and for the QQQ, probably 90% of that move down occurred at the opening bell. 10% on a net basis was during the day. And then when we rallied back up, you can see all these hollow candles, very few filled candles. So it's just continual accumulation, in my opinion. When we went back to 2008, when I looked at 2008, the difference was mind-boggling. We lost about 85% of that move when we looked at the end of September of 2008 to about October 20th, when we had that big drop down. About 85% of that was selling during the day as opposed to at the open. So there was actually distribution taking place during the day. And we ended up going down, coming back down in November and then setting another low in March of 2009. So the distribution was smart back then because prices kept going lower. I'm not seeing that in this market. And that's why I question whether we're going to go back down to where we were prior. I mean, usually I'd like to see a double bottom. I don't know that we're going to go all the way back down there. I think this week we could weaken. Maybe we go down, test that 20-day. We'll see what happens if we get there. But I think there's been so much evidence of accumulation. I don't know that the prices are going to get that far down before we see buyers step back in. But we'll see. We'll keep evaluating it. But here you can see the spider. See how we down initially, came down, bounced right back up here, and then we went to this low here. We never took out that prior low. And we haven't broken out, but we're up near a 52-week high right now in accumulation distribution here. So that's what got me thinking accumulation distribution, but I still want relative strength. I don't want to sacrifice relative strength and only look at accumulation distribution. We can have both. So why not have both? All right. So let's get back to that chart, RPM. So these are charts. These are companies that have already reported. RPM reported on April 8th. Again, they beat bottom line. They missed top line though. But when you look, here's your accumulation distribution. Prices were going down, but accumulation distribution holding up pretty well. And you might say, well, how's that possible with this huge red candle? Well, remember, accumulation distribution doesn't care. OBV would treat this horribly. You finished here one day, the next day you closed here. It was a big down day. All the volume that day would be negative on OBV. Accumulation distribution looks at this and says, well, here was the high, here was the low, and we closed in the middle, maybe even above the 50% middle. So technically, this was a positive or maybe a slight negative. Again, I can't tell if it's 50% or a little above or a little below the middle, midpoint of that trading range. But that's how accumulation distribution is calculated. You can go into Chart School at Stock Charts and go back and look at the formula. But when I started looking at the formula and I saw that it was based on volume and where it trades during the day, that's when I said, light bulb went off and said, hey, this is definitely an indicator that can help us in this market. And so you can see we've been bouncing back. We've got new highs on RPM, and they just came out with their earnings on April 8th. Right here, stock traded up pretty solidly after, actually this would have been 13th, which was Monday, 10th, 9th, 8th. So it would have been right here. So this heavy volume move above the 20-day moving average, we continued moving up. So this was about 62. We got up to about 69 before just kind of going sideways here. But we're trending above the 20-day moving average. I think RPM looking pretty good here. Actually seems to have a lot of RPMs here on its chart. When I looked at the relative strength, this is a stock that's been moving higher. Middle of March set a new high in terms of relative strength. Lows continue rising. So this one actually looks pretty good to me. The only problem I have is that it's not going to go on the strong earnings chart list because they didn't beat their revenues. Being a former practicing CPA, I take management's word as being pretty important. And when companies don't meet their, basically all the information they've been giving analysts come up with projections based on talking to management. So when they miss their forecasts, to me, it's a little bit of management not really holding true to its promise. And so normally we don't trade stocks. I don't trade stocks unless they're on my strong earnings chart list. I want to know that management is executing their business plan. Well, management can't execute a plan when they don't know a massive pandemic is coming. So we've kind of moved away from that model. We still have the strong earnings chart list, and I still look at it, but I'm trading almost exclusively off of my strong AD chart list. And I'm not shorting, but if I were shorting, I would trade off of the weak AD chart list. And again, I'll go over those in a little bit. But RPM, even though it didn't meet its revenue estimates, I still think looks pretty good based on the way it's been trading since its earnings report, and in terms of both relative strength and the accumulation distribution, I think looks good. The biggest problem with our RPM is that its industry group has been downtrending relative to the S&P 500. So it's just in a weak area of the market. But the stock itself is holding up. The company's doing very well, considering. Another stock that I think, and this is one that I really do like, that beat top and bottom line. Talked about this one before they ever came out with their earnings, and that's Johnson & Johnson. I thought the stock was looking really good. check out the huge drop, 152.5 down to 110. And throughout that entire process there, and even with these 3 big red candles, we never went below the prior low in terms of accumulation distribution. And as soon as we got this back, we were breaking to a new high. When we got above the 20-day, we were already back up to a new accumulation distribution high. And when I pull up the relative strength and look at Johnson & Johnson, look at the overall uptrend relative to the pharma peers. See how this line's going up? So you've got J&J, which is outperforming the pharmas. And oh, by the way, pharmas are outperforming the S&P 500. So you've got a strong industry group in pharmas. You got one of the strongest stocks, or certainly a very strong stock within the pharmas. And then when we go back and we look at the accumulation distribution, we've got a stock that's breaking out in terms of accumulation distribution. Now, would I buy it right here? No, because it literally just went up against key resistance. So I don't want to throw out all the things that I know about technical analysis. This is where you're probably going to see some sellers come in. If I own the stock on the way up, I would certainly be thinking about selling as I hit major resistance. So, but this is one that's on the radar that when it comes back down, if it comes back down, maybe gets a 20-day test, this is a stock I'd be all over. So J&J, great report. This next one is in an area of the market that has been horrible, but somehow this company is holding in really well. And this is First Republic Bank of San Francisco. Banks have been horrible, but look at this relative strength. When it was going down, look at all these hollow candles. So everybody's selling it because, again, everybody's selling everything in the market. So FRC was going down with everything else at the open, but then buyers were emerging. And you can see almost all of these very strong hollow candles. And that's what took the accumulation distribution to a new high. Now, it did pull back a little bit when it set this bottom, but now that it's coming back up, it's moving to new accumulation distribution highs again. The problem is, and by the way, they beat top and bottom line, so they will be on my strong earnings chart list when that gets updated. FRC, though, when you look at it relative to the banks, look at this. If you're going to own a bank, and I'm not suggesting you own a bank right now because banks are horrible with rates dropping, yields dropping, but this one's held up well and is one of the leaders. So if I was going to own a bank, certainly the FRC would be one that I would want to own. All right, let's see, what else do we have? All right, hold on one second. Okay, let's take a look here at, what's another one? How about Abbott, ABT? And again, these are all stocks that have already reported earnings. So Abbott came out on April 16th. So would have been, what's today, the 20th, so it would have been Thursday. And they beat top and bottom line. And I would have predicted that they were going to have a pretty good report based on the way it was trading. I mean, again, off the bottom, check this out. I mean, a couple of filled candles, but for the most part, it has been straight up and a lot of hollow candles on the way up. So when you look on a relative basis, Abbott, which a month ago at the bottom here wasn't looking that good, but all of a sudden, and maybe it's because of the coronavirus, they're working on, vaccine and so forth. Here you got Abbott making this big push to the upside since the bottom. And not only has it broken out above recent relative highs versus pharmas, but it actually broke out above a 52-week high. So this is a company that's performing really well. Look at the volume coming in on this push to the upside, being supported. And again, pharma's very strong versus the S&P 500. Now, let me show you the relative strength here. Or not the relative strength, I mean the accumulation distribution. So here's your accumulation distribution. So when all this selling came in, we basically went down and retested this prior low. So we had lower lows in price, but not in AD. And then as we came back up and broke out, we're also breaking out in accumulation distribution. So Abbott, beat top line, beat bottom line, strong AD, strong relative strength. That's one that I certainly would keep an eye on and be interested in on any pullbacks. ISRG, Intuitive Surgical, reported last week. Beat on the top line, beat on the bottom line. Another one that looks really good to me. Check this huge drop, 620 down to 360. Really big distribution, right? Massive distribution. Well, not according to the accumulation distribution indicator. Look at all these long tails to the downside. Those long tails, if you're not a candlestick fan, a tail simply means that you had an intraday move way lower. That's what the tail represents, comes all the way down here and marks the intraday low. So on this candle right here on March 13th, that low would have been around 432. But we closed at 470 and change. Well, obviously there were a lot of buyers from 432 up to 470 something in order to get that kind of movement back to the upside. But you see a lot of these days where you have these huge moves down and big recoveries. Look at these 3 days. Long tails down below 400, but we kept coming up and closing above 400. Somebody's buying to change the fortunes of the stock intraday. We're not seeing this with airlines. We're not seeing this with cruise lines. We're not seeing this with hotels, gambling stocks, travel and tourism. We're seeing it with healthcare stocks. We're seeing it with a lot of technology stocks. We're seeing it with consumer staples. We're starting to see a lot more with consumer discretionary. These are the areas that the market is favoring. So if you're going to trade on the long side, these are the types of stocks you want to trade. Look at what ISRG has been doing. Look at all the different tests of its 20-day moving average in the last 2 weeks. Every one of them was a buy. So first thing I would suggest is that if you're, want to trade a stock on the long side and you see Intuitive Surgical down intraday, testing a 20-day moving average, or maybe it goes below the 20-day and you can catch it when it comes back up above the 20-day, that could be a great trade. And those are the types of trades that I'm looking for right now. So ISRG, great accumulation distribution, this huge rally back to the upside. If we pull up the relative strength chart, versus medical equipment, this one actually has not been one of the strongest. So we'll find some others, and there are probably a bunch of them on my strong AD chart list. But knowing that it's in a strong group, knowing that it's trending above the 20-day, knowing that the AD line is so strong, if it were to pull back, I would definitely still be interested in it. But knowing that it also is not one of the strongest medical equipment stocks underscores the fact that I want to make sure I keep my stop in play. I don't want to break down the 20-day knowing that I've got one of the weaker stocks in the medical equipment area. Now, I think some of this could change, especially with the company beating its top and bottom line with its earnings, and it's trading so much better in the short term. But we should also start to see that in the relative strength. I'd feel much better about ISRG if, on a relative basis, it was up here and had recently broken out above its peers. But that's not the case. But medical equipment stocks have been doing extremely well versus the S&P 500, straight up. So you're in a good area. If you're trading ISRG, you are in a good area of the market. It's just that there are others in this space that have been doing a lot better than ISRG. So those are some of the companies that have already reported that I would be very interested in. Maybe another one would be UNH, United Healthcare, another one in the healthcare area. And again, this one went up, tested resistance, pulled back, not a surprise. Watch the two moving averages there. Also, we broke out above a little bit of resistance around 268, 269. So I think you get down below 270 in this stock, it's going to start to get interesting. And UNH relative to healthcare providers has been trending higher. Healthcare providers versus the S&P has been trending higher. So good industry group, good solid stock within the industry group. Hits resistance, pulls back. So you want to be a little bit careful. But when we look at the accumulation distribution, breaking to new highs. So again, that would maybe be the fifth one that I would throw in there. All right. Now let me give you the opposite of what I would be wanting to short, if anything. Let's take a look at Wells Fargo. Let me show you what it looks like on the other side of the spectrum. So Wells Fargo reported back on April 14th. They missed their earnings per share number. If you look, they're down near their lows that were established back in March. We've had a nice rally in the stock market. You wouldn't know it by looking at Wells Fargo. It's been horrible. And you also wouldn't notice, we've been talking about all these great looking accumulation distribution numbers and indicators. Look at this one. just set a new 52-week low. How about relative strength? Well, we already know banks have been horrible. So you can see the banks have been going down. Well, Wells Fargo versus banks just set another 52-week low. So do you see the difference? Now you've got a really weak area of the market, one of the weakest stocks, and accumulation distribution, which is dismal. So that combination, if I see any kind of strength, I would want to be thinking about shorting it rather than going long. All right. So let's move on to upcoming reports. So now we've got some companies that are going to be reporting. I had IBM on my list, and I tell you, I wasn't a big fan of IBM. Let me pull this one up. I had an X next to it. Let me see why. Accumulation distribution doesn't look bad. Must have been relative strength that I didn't like. Yeah, IBM down near 52-week low heading into its earnings report. And its group, Computer Services, coming off the low in March. That was a 52-week low, so it has improved. But still, I mean, if you look back, at best, you can say maybe it's sideways consolidated versus the S&P for the last several months. So it's certainly not one of the better groups. And then you've got a stock that's not one of the best stocks within a group that's not one of the better groups. So that combination would have me a little bit concerned about IBM. So I think John said it was down a couple hours after hours, or a couple dollars after hours. So I don't know. IBM is one that I probably wouldn't be too keen on. One that was reporting after hours, though, and I already saw that the stock was up, or it had beaten top and bottom line estimates, is Cadence Design. But I also saw that the stock was down. I think this could be a buy on rumor, sell on news kind of situation. I actually like the stock if it were to recover back. If it pulls back, hit say the 20-day moving average in the coming days, I would be very interested in CDNS. Look at it. It had been downtrending. It looks like that downtrend line was broken back in March, and we have been uptrending. CDNS has been uptrending versus software since mid-March, which I think is a positive. Software is a great area of the market. So if I could get this stock closer to its 20-day moving average, I could keep a stop in play in the event that its relative strength starts to roll over and it doesn't hold the 20-day. But if we get some sell-off because of its earnings, buy on rumor, sell on news kind of thing, this, I think, could set up very well. And again, another stock that tested resistance and pulled back. I mean, that ought to tell you something. The S&P 500 is not back at where it was February 19th, but CDNS is. So on a relative basis, this has been a really nice winner. Now, in terms of its accumulation distribution, you can look at what's happened. What happened on the way down? See the move to the downside? See this rally in the accumulation distribution? As it was hitting a low, this stock was down 28, so that's 35%. 35% in 3 weeks. And the accumulation distribution is breaking to a new high. I mean, throughout this move right here, I see a lot of big hollow candles, but I see very few filled candles and a lot of tails where we're recovering off of lows. That's why the accumulation distribution, while the market's going down, the stock's going down. If you're looking at it in your portfolio, you're saying, wow, CDNS is a horrible stock. But why? I think it was, and I said this in an article, I think it was an article recently that I wrote. I said, professionals are buying while individuals are selling. I mean, that's what it looks like in a nutshell to me, is that all the fear, and I know some people don't like it when I get on my high horse about the media, but I do think the media exaggerates things. And I think the selling, the fear that was accompanying the coronavirus is bad enough by itself. Doesn't need all of the, this is going to be the Great Depression kind of discussions that you were getting from a lot of these media outlets. And so I think really what this whole episode in the stock market the last 2 months is really what I visualize is that you're getting the mom and pops out there who are seeing all these horrible news and their portfolios going down, being told this is it, the Great Depression's coming, and they're selling. And then I'm seeing accumulation and who's buying. I mean, I was reading an article at one point, somebody was saying, well, professionals are getting out and individuals are buying. Come on. individuals were scared out of their mind. Individuals weren't buying. I don't know. I hardly know anybody. Everybody comes up to me and talks to me about what's happened over the last month and a half is talking about, should I be getting out? Should I be getting out? Nobody's saying, hey, man, I have just loaded up on this. That's not the way it works. When you get fear building, individuals are selling. Now, if professionals are selling too, then we're going to have what we had back in 2008. We're going to see it in the accumulation distribution. We're not seeing it. So, well, we are seeing it in some stocks, some areas of the market, but not in all. And so I see big money simply rotating. I see them using this as an opportunity to get out of the losers and jump into the winners going forward. That's what professionals are doing. And then when we break out the all-time highs later in 2020, 2021, everyone else will be like, wow, I guess I'm going to have to get back in. I mean, unfortunately, that's the way it works. But I'm talking down the road. I mean, could we go back down again short term? I'm not trying to minimize the fact that we've had technical breakdowns and we could roll over again. But unless the whole accumulation distribution changes, which I doubt is going to happen, but unless it does, I believe that this next bout to the downside, we'll see very similar action. We'll see a lot of accumulation taking place as we're selling off. Okay, so anyway, CDNS I thought looked pretty interesting. John mentioned Netflix. I want to bring up Netflix. They report tomorrow. I love Netflix. I think Netflix is one of the companies. There was a show that I did on Stock Charts TV a few weeks ago with David Keller. He was hosting. Grayson Rose was on the show with me, along with my former co-host on Market Watchers Live on Fridays, Mary Ellen McGonigal. And the three of us each gave 5 stocks that we liked as a result of this coronavirus and maybe the paradigm shift that was going to take place from more and more people working from home and so forth. And Netflix was on my list. It didn't make my top 5 that I gave to Dave Keller, but it was one of the short list stocks that I had. I really liked Netflix, and I don't think Netflix was brought up by either Mary Ellen or Grayson, which I'm kind of surprised. But think about what Netflix does. I mean, a lot of people weren't going to movies before the coronavirus. A lot of people gave up going to movies. They had Netflix. They were watching their movies at home. Netflix was producing their own shows. I mean, a lot of series, binge watchers using, finding some great shows on Netflix. So it's just been this huge behemoth internet/entertainment company that's been, growing and growing and growing. Well, now all of a sudden we're being forced to stay home. Everybody's being forced to stay home. You can't go to a movie if you want to. Movie theaters are closed. So now people who maybe didn't want to pay for Netflix are now paying for Netflix and experiencing what everybody else has been experiencing for the last several years. And so their subscribership is probably going to go through the roof. And that's why massive income or massive volume has been incoming into Netflix as it breaks out to all-time highs. If we go back on the monthly chart, you'll see this is the highest it's ever been. And we're in a really bad bear market. We're heading for a depression, right? But everybody's going to watch movies in the depression, I guess. I don't know how else to explain it. I mean, if it's going to be a Great Depression, we're all going to be watching Netflix based on the way it's trading. I'm kind of being a little facetious. I do not see a Great Depression coming. We have a 1-year window. We've got a mess on our hands, no doubt about it. The scariest part is the virus itself. I mean, I know financially it's been bad, but virus is a real deal. And so, and I hope everybody is practicing social distancing and staying at home and following, government suggestions and orders in many cases, because we do want to flatten the curve. I mean, we got a lot of folks out there, healthcare workers that are on the front lines, doing a lot of great stuff. And, if we can just do our part just a little bit to make their jobs a little bit easier, it'd be great. I'm not going to get off on that tangent, but I do want to recognize all those healthcare workers out there, because I can't, as much as we're fearful going out to Costco or, to a grocery store, just imagine going into a hospital with hundreds of patients in ICU on ventilators and I can't even imagine. So keep all of those folks in your prayers and recognize what they're doing, and let's all do our part to help them. But anyway, so we got Netflix. Netflix looks great. I think they're going to report absolute blowout numbers. Now, will it be a buy on rumor, sell on news? I don't know. But if it is, I'd be a buyer of that weakness. I think Netflix stands not just to benefit in the short term, but I think, again, this is a paradigm shift. I think a lot of folks will be at home more often going forward. And I think a lot of people will develop habits of watching movies on Netflix, which are a lot cheaper than going out to the movie theater. So, not only is this going to be a positive for companies like Netflix, but I think it's a negative for companies like AMC that depend on people coming out to the movies. I think this is going to be something that changes our habits. All right, another stock coming up on Tuesday that's going to be reporting, and I think this one's going to be a really interesting report. I haven't looked at it last couple of days, but Lockheed Martin. Now, Lockheed Martin, with that huge drop, $440 to $260 and change, big drop. Right at the bottom, or close to the bottom, we were almost ready to break out on accumulation distribution. So again, everybody's panicking out, but I think there are a lot of buyers, and you can see how quickly this recovered. And some of them that recovered, that got hit really hard and recovered early. The airlines recovered really strongly at first. The cruise lines, many of those areas recovered, but then they haven't been able to break back out above those earlier highs. Lockheed Martin just keeps going. So pullbacks have been very viable. You can see some of these red hollow candles. That's where you gap down at the open, and then you close higher, but you're still down for the day from the prior day. So for instance, here's a red candle that's filled that's around 340. Try and get that cursor out of the way there so you can see it, but that 340 level at the end of March, we gapped down here to about 325. We came back up. We closed at 339. That, to me, is a very bullish candle. But, and according to accumulation distribution, that was about the time we were ready to break out on the accumulation distribution. Now, if we substituted this and went with on-balance volume, that same day right here, that same day, we go down on OBV. See, OBV looks like it's going down. Well, if you got a lot of down days, OBV doesn't care how you traded intraday. It just cares, were you down from the prior day's close? If you were down from the prior day's close, then we take the volume and we subtract 100% of that volume. Even if you had a day like this where you gap down and you're rising $14 during the day from 325 to 339, clearly there's a lot of buyers. We're still going to take that entire day's volume and treat it as a negative, which to me makes no sense whatsoever. So if I'm looking at OBV versus accumulation distribution in this market that we have right now, this is a no contest, slam dunk, get rid of OBV and put accumulation distribution on your charts. OBV is useless in this market. I'm not saying it's always useless. Every technical indicator, I think, has its strengths and weaknesses. And normally I like OBV along with accumulation distribution. I kind of would look for them to confirm one another. But again, based on this market, the intraday action, the recoveries that we've been seeing for the last 6 weeks, I think OBV is incredibly misleading. And so it would not be on my charts. But let's take a look at LMT on the relative basis. Because if we go down here at the bottom, you'll see defense stocks really haven't been doing that well. But even though Lockheed Martin's part of the defense, it just set a 52-week high relative to the S&P. And it is crushing its defense peers. So if you're looking for a stock that's maybe in a beaten down group that's really strong, I think Lockheed Martin would be one of those picks. And so seeing how they report, I think it's going to be really important. If you're in defense stocks and this company doesn't come out with good numbers, I would be out of all the other defense stocks because this one has been outperforming. Wall Street is putting money into Lockheed Martin relative to the other defense stocks. And if Lockheed Martin disappoints, I'd be very careful with those other defense stocks. I think another one that looks pretty good in that area is AAXN. It's a smaller company, but you can see relative strength here. And I think also if we pulled up AAXN on a accumulation distribution, see the same thing. See this huge move down? And look at the AD, just keep going higher and higher. just keeps rising. Look at all these hollow candles at the bottom. A lot of buyers down there. Again, a lot of folks panicking because the stock dropped from 90 to 50 in 3 weeks. Of course you're going to panic. If you've got that in your account, you just lost 45% of your value of that particular stock. It's going to be hard not to panic. But the charts tell you that it's being accumulated. And 2 weeks later, the stock is back up 50% from where it was down here. Tried to break out again today, didn't quite make it. But a close above 77.50 there would be bullish. But anyway, AAXN is not going to be reporting anytime soon, so I shouldn't spend any more time there. Another stock that I really like is reporting on Tuesday, Chipotle, a restaurant stock. Look at the accumulation distribution. It has been on fire. So again, everybody's panicking out. Stock was $9.50, went down to almost $400. And accumulation distribution breaks out to an all-time high while that's happening. And then look at it recover. You think professionals weren't buying? You don't think this was a useful signal? I think it was a really useful signal. Let's take a look at a couple that are going to be reporting tomorrow that I would not own if you forced me. If I had to own it, I wouldn't own it. Synchrony Financial, SYF. Remember, I was just showing you the bounce back and how a lot of companies have kept going higher. The S&Ps kept going higher. NASDAQ 100, everything's going higher. Here's one, never could break back up above that initial 3-day rally. March 26th high, haven't been able to get there. We're down near these lows. Look at the accumulation distribution. Completely opposite everything else you're seeing. There is distribution taking place. When you get all these filled candles in here, that's distribution. How about UAL? Ugh. Another ugly one. This one reports tomorrow. Not good. There's your 3 or 4 day, 5 day, whatever recovery. Here was the recovery into option expiration week in March. So we were down to 17, came back up $10. Actually, on the Friday of option expiration, this was a stock, actually it was one I mentioned as Max Payne back in March. It went from $17 or $16 to 31 in 3 days, 2 days. I mean, it was crazy. And it, as in my opinion, it was only options expiration. The week after options expired, it continued to show a little upside movement. And then it started the same thing all over again, back to the downside. It's had a couple little hollow candles in here. So we've seen a couple little spikes in the accumulation distribution. But for the most part, just keep going lower and lower. I think UAL probably not going to have a very good report. And I mean, just think common sense. I mean, I think they came out, the airlines have come out and said that they have 90% fewer passengers right now than they had 1 month ago, or maybe it was a month and a half ago. 90%. Imagine any other business that had 90% fewer customers. You're not going to be around very long, especially with all of the costs, the fixed costs that you have in the airlines, and how, you know, they need scale. They can't take 2 people from New York to Los Angeles and make any money. The fuel alone is way more than those 2 people can pay. So, you know, well, maybe the fuel isn't based on what we're seeing with crude oil prices. Maybe they're going to get paid to use the crude oil. But you know what I mean? I mean, you've got to have scale. And right now, airlines have no scale whatsoever. And the bigger question is, when are people going to really be comfortable flying again? I mean, the one place you don't want to be with the coronavirus is in a controlled atmosphere, which is exactly what you have inside a cabin in an airline. So, yeah, I mean, I can only imagine it's going to be a bad report. 2 more stocks, and I'm going to give you some emerging leaders. Wow, I just looked at the clock. I'm falling way behind. I literally can't keep my time down, but I'll try to pick up the pace here a little bit. So TMO reports on Wednesday. Thermo Fisher, look at the accumulation distribution throughout all this move to the downside, and then let's look at the relative strength. Thermo Fisher on a relative basis. Now, remember I was talking medical equipment and saying ISRG didn't look very good. Well, we had a huge spike here in Thermo Fisher. We pulled back, but the overall trend in this one is definitely higher. So now you've got one of the leaders in medical equipment, very strong accumulation distribution. So this is one you certainly should be thinking about. Also on Wednesday, last one I'll point out here is PayPal, PYPL. Another one going down, and when we look at it on a relative basis, it is actually going up versus computer services. as opposed to IBM that I showed you earlier was down near 52-week low. Well, Wall Street, essentially what we're saying here is that money is coming out of IBM and going into PayPal on a net basis. That's what Wall Street is telling us. And then when you take that and combine that with the accumulation distribution, which is at a 52-week high right now, it's telling me that if you get any weakness during the day early, a lot of times that's a great time to be a buyer of PayPal. All right, so next we're going to go into emerging leaders. This is the last section. What I want to do first is I want to show you these two lists that were developed. The strong AD list. And what I did, very simple, is I went through every sector and I ran a scan. Scooters above 80, scooter scores above 80, got to be a pretty good relative performer to get a scooter above 80. And then I pulled up the AD lines on all those stocks that had scooters above 80 and made sure that the accumulation distribution was strong. And I put together a chart list of 354 companies. And I believe at least for the foreseeable future, you could trade using that chart list and you don't need anything else. I mean, if you like to trade on the long side, now if you want to trade on the short side, I'll show you the weak AD list in just a minute. But here's the accumulation distribution. You can see it's very strong. This is the first stock in the list, Agilent. Stock was down today. I mean, if we get back down close to the 20-day moving average, this could be one that certainly would be worth considering. Let me show you in summary form this list. Now, what you see here are the top scooters. So this is sorted right now, these 354 companies. And if I bring up the edit mode here, you'll see how many companies there are right here. 354, you can have up to 500 in a chart list. 354 companies. So I just wanted you to know that there are 354 in here. And let's go back to the summary. So in scooter order, I want you to know that first of all, today, if we go to the dashboard, you will see that the S&P 500 was down almost 2%. The Dow was down 2.5%. NASDAQ was down 1%. Small caps 2%, mid caps 1.8%. S&P 100 1.6%, NYSE 1.8%. Bottom line is the market was down today. Look at the best performers, the high scooter ranked. Look at their performance today over here. I mean, we got a 16% winner, a 22% winner, a 15% winner, 7% winner, 12% winner, 14%. That's just what you can see here. If you're looking at these top ranked scooter stocks that have strong accumulation distribution, you're going to find that a lot of these companies perform extremely well and much better than the overall market. That's how they get these scooter scores to begin with. And if I flip it and we look at the ones that, well, actually those are, let me go back down here to the, well, let's look at the percentage change. So here was the best performers today on this list. And you can see most of them carry very strong scooter scores, most of them in the 90s. This one didn't have a scooter score. And that was another step that I had to go through in my process, was to go back and look for companies that weren't ranked, that didn't have a scooter ranking, because obviously they wouldn't be picked up. And so I had to go back and look at some of those that had performed well, pull those up and look at their AD lines, and some of them were added, like PDD. So, but anyway, you can see multiple, look at how many companies, 4, 7, 9 companies on this list out of 354 gained more than 10% today. And I did a thing here, that's 9. I think like 25 of them gained more than 5% today. All right. Now keep that in mind for just a second. Let's go look at the weak list. Now the weak AD list was put together by simply looking at scooter scores that were below 20 and had weak AD lines. So it's just the exact opposite of what we had in the strong list. Now, when you look at the strong stocks that were in the weak, remember we had, what, 9 stocks that gained more than 10%? The weak list had 2 that gained more than 10%. The weak list had 6 that gained more than 5%, as opposed to 25 or whatever the number was. And if I go to the bottom of this and look at the losers, look at all these stocks that have lost more than 5%. Starts right here And so from there, let's see, that would be 25, 50, 55, 60, I don't know, probably 67 stocks, something like that, out of 254. So we're talking about, that's roughly 25% of all the stocks on this list lost more than 5% today. Again, the market was only down 1 to 2%. So if you're looking for shorts and you want to outperform, this is your list. Now, if we go back and we look at the strong stocks, again, if you're going after some of these stocks with really poor scooter scores and really poor accumulation distribution lines, and you think you're going to make money, out of 254 of them today, 9 of them gained more than 3%. So good luck finding which ones are going to have really good days, because there aren't very many of them. Whereas again, if you look at the strong, not the strong earnings, let's go back to the strong AD list, you got a lot more on a percentage basis that gained more than 3%. Let's see, there's 25, roughly about 50. There's about 25 a page. So 2 pages. So about 50 stocks gained more than 3%. 50 out of 354. And hardly any on the weak AD list. So when I talk about emerging leaders, I think you've got to be looking at this strong AD list. And I think you probably would start by looking at the scooters, the strong scooters. Now, I mentioned earlier, I gave 5 stocks to Dave Keller on that show over at Stock Charts. It was called The Pitch. You could go to YouTube and search for it. Just type in Stock Charts, The Pitch. I'm sure that video will come up. But I gave 5 stocks. One of them was Regeneron Pharmaceuticals, and gave it 3 weeks ago. And I've been talking about this stock for a while. I've been talking about biotechs for a long time. If there was one group that you said you've got to buy right now and hold for the next 3 years, what would it be? For me, it's biotechs. Based on what I'm seeing right now, it would be biotechs. But look at REGN. I mean, this thing has just been on fire, continues moving up. But even when the market was pulling back, REGN really didn't. It was really just sideways consolidating. And I think the biggest problem here is it was trying to break out with a negative divergence. Once we got back down close to the 50-day, we got close to the center line, we have seen this thing take back off again to the upside. Accumulation distribution is through the roof. You can see just continually powering forward. A lot of folks jumping into this stock. Now, do you want to rush out and buy it at 567? Well, if possible, I'd like to see it on a pullback. I mean, you can go back and look at some of these other days. You can see a lot of intraday tails to the downside. So you might be able to get this stock 520. I mean, I don't know. I'm just saying, you know, be patient. You got 354 stocks on this list. Be patient. There are probably some other trades that you don't have to risk as much to the downside. You know, you might be able to catch them closer to the 20-day moving average. But this is certainly a stock that looks pretty good. Another emerging leader. Probably never heard of this company. It's a small company, ChemoCentryx. You may not realize it, but just closed at an all-time high today, 51.66. Had these 2 highs over here, 50 and change. Today, 51.66. And if we just look at the last couple of months here, get rid of that big volume candle from November. Oh, that was 3 years. That's not what I want. 3 months. You can see the volume has started to pick back up again here these last few days. So trade over 500,000 shares. That's a decent volume day on this stock. Made the breakout. I think this is a stock that's poised to go higher. But again, it's been trading higher. It's probably a little overbought, but it's on the AD, strong AD list. So one of the things I've suggested to Earnings Beats members is to use this list and find stocks that are weak in the morning hours. First 10, 15 minutes, maybe 30 minutes, pull it up and see what stocks are weak. And you can do that very simply by being in that chart list and just clicking on the change column, percentage change. Click on it twice. Now, this is what's telling me what closed weak, but you can do the same thing 10 minutes, 15 minutes into the market, and you can see which stocks are performing poorly, and then just don't rush out and buy them. I mean, look at the chart. If you get some of these stocks that have Scooter, you know, this one's up near 95. And by the way, this chart list was put together couple weeks ago. So you can see some of the scooters now are below 80. They were above 80 when they went on this list. So some of them have weakened, but some are still, you're going to see them down the bottom here, have had a rough day, but still very strong. I mean, there's a 94. Here's a 92. Here's a 98 biotech stock with a 98. This thing was trying to break out 3 days ago at $8. Now you can buy it at $6.25 as it gets down closer to this gap support area, moving average. This is a stock that easily could bounce off of that. So that's how I would use this this chart list. But again, let's go back to the percentage moves there. And so this is today. I mean, you could probably say, well, give me the last month. And if you really want to find potential winners, and I wrote about this one today in my Trading Places blog, Inseego. Didn't really know too much about this stock, but it's a 5G and cloud stock. It's a $1 billion company instead of a, $180 billion company or a $1 trillion company. It's a small company, but look at the accumulation taking place. Look at the accumulation distribution line. I think you probably can see that the relative strength is going to be off the charts, which it is. So you got telecom, which looks to me like it broke this downtrend line versus the S&P, went up, kind of been pulling back a little bit, but I wouldn't be surprised to see another move up. If it moves up, this is one of the strongest stocks in the space and with a very strong accumulation distribution. So this is a type of stock that I would say would be perhaps an emerging leader. How about, let's see here. Specialty retailers have been very strong. Carvana. Look at the accumulation distribution rising. Look at it. When it was going down, it went from 110 down to 22. Now, sometimes I wouldn't necessarily look at that and look at the AD line and say, hey, I'm going to jump in. But on its recovery, it's gotten back a lot of its losses. So its relative strength, which I'm sure went in the tank, has rallied back. Look at this rally back versus its specialty retail peers. And look at specialty retail breaking out versus the S&P. So you got a strong industry group, a stock that's bouncing back very strongly, great volume trends. And again, if we go into that accumulation distribution, look at that. We've got a stock that's been trending higher. So those are all the things that you want to look for in potentially new leaders. It's at 80. Its 20-day moving average is at 65. If you buy it here, it might have a little risk, a little more risk than you're willing to take. But if over the course of the next week or so, the stock pulls back, the 20-day keeps rising, you might be able to trade a stock like this closer to a key support level. There's no reason to jump in and chase anything because you have so many stocks on this list that are potentially going to provide some opportunities for us going forward. Another one that I think looks really good, emerging, Dexcom, breaking out to a new high. Look at the accumulation distribution. Look what happened back in March when it fell down. Accumulation distribution was moving to a new high. Then you throw in relative charts. First of all, it's in the medical supplies area. Medical supplies is just kind of going along for the ride. It's actually the weakest part of healthcare, but this is a huge relative leader in medical supplies. Volume coming in, breaking out, and again, that accumulation distribution line going higher. One other thing I want to show you before we end, and this is more for folks that are new to earnings beats. If you go to our website, well, you're not a member, so you won't be able to see this. I want to show you something. And you'll be able to get this, by the way, just by being a trial member. You don't even have to be a paying member yet. These chart lists, if you go in, so this is what members see when they're in. They can see all the different areas you can go. So under the member area, you can go to chart lists. And you can go down to this accumulation distribution chart lists, strong ADCL, weak ADCL. And if you click on the link, and well, I've already been in it, so it's not going to ask me for it. But if you go in it for the first time, it'll ask you for a password. And all you have to do is type in the password. Now, you're going to need the link. But if you go in there and once you're in, if you're an extra member or above at Stock Charts, if you're not, go sign up. They have a 30-day free trial. Do their 30-day free trial, do our 30-day. Essentially, it's a free trial. You're going to get charged $7, but we will refund it to you within a few business days. So net, it's a $0 trial. If you do stock charts for 30 days and you do earnings beats for 30 days, I promise you, you're not going back. All you have to do as a stock charts member is hit this save to chart list button there. And then you can just bring it up as a new list in your account, which is, if you don't have one prior, that's what you would do. But let's say you're in and you've already gotten this list, you've downloaded it, and now I come out with a new AD list next week, say. And I say, okay, new list is ready for you to download. When you come in here, all you have to do is hit replace list, go down to this AD listing, hit save results, and it just writes over your list, just like that. So you go into our site, literally in 5 seconds, you'll have it in your stock charts account. 354 charts. Same thing if you go in, by the way, and do the week AD. You just type in that password. See, now I haven't done this one yet. So if I just type in the password, hopefully I typed it in right. I unlock the list. There it is. And then save it to your account. So, and I always give stock charts a lot of credit because we used to have to ask you for your user ID. You would have to tell us your user ID. And what we would do is we would go in. And so we would go into our chart list. We would go to edit. And you would send us your user ID. And we would have to go in here for each individual person and say, okay, Harry test member 234, whatever your user ID is. And we would have to click OK. And then we would have to go to the next person that is a member at Earnings Beats. And we'd have to send these chart lists out one at a time. So if we had a strong earnings or a strong AD chart list, let's say I wish we had 20,000 members, but if we had 20,000 members, imagine sending out this chart list one at a time to 20,000 people and then going to the week chart list and sending this out one at a time to 20,000. I mean, again, in my dreams, we have 20,000 members, but I think you get the point. It was a very, very detailed, disgusting task that Aaron had to do for a while. But like I said, Stock Chart stepped up to the plate and they gave us this platform. They set it up for us, which is awesome because now we just tell you that the new link is in the website. You go click on the link, download it into your account, put the password in, whatever, boom, you're done. Literally in 5-10 seconds. And on our end, we just put the link up there. So anyway, I just wanted to point that out because if any of this is resonating with you and you think it can help you in your trading, take out that free trial at Stock Charts, or if you're already a member there, take out our free trial and download these two chart lists. Again, if you're short, get that week chart list. If you like to go long, get the strong chart list and have that in your account. It will completely change the way you're looking at the market right now. But that is it. I went way over. I went an hour and 15 instead of 45 minutes. But even for me, hour and 15 is not too bad, John.
Hey, Tom.
Yeah.
Just while you've got the screen, just let people know who are in here. If you want to, well, I'll just tell you, if you want to come to the next event, which will be a week from Monday, like Tom said, it'll be this on steroids, but specific focus on stocks that have reported or have earnings coming up. You can sign up, for where it says join today. You're basically signing up for nothing. It's $7, but you get that back in a refund. And then even better, go up to the top there, Tom, where we've got the webinar special up the top. Yep. You can sign up for a tremendous deal, which includes a 1-month bonus you got to do by the 22nd of April. If you're going to be with us a while, you're a trial member now or monthly, you just won't beat it. And you get everything that we have to offer to our members, including all these great sessions, these new features that Tom talked about, the AD list, strong and weak, really well worth it. So I suggest, number one, if you're not a trial member, get signed up so you can come to next week's event plus everything else for the next 30 days. If you're already a trial member, take it. By the way, if you don't want to sign up for a full year, if you scroll down time, you can also take a semi-annual. There's no bonus month, but you don't have to put out as much money. So that'll be up to you. All right, my friend, that's it for me.
All right, that is it for me as well. Hope everybody enjoyed the session. If so, and again, if you're not a member, sign up. You can come back next Monday. We'll do it all again. Everybody have a great evening. Be back tomorrow morning at Stock Charts TV for Trading Places Live. Check that out. Everybody have a great night. Happy trading.